What's going on, guys? Welcome back to this week's video. Today I want to take a look at my investment accounts and show you why I'm investing in certain stocks and why I try to avoid other ones. For obvious reasons, I won't be showing the dollar amount, but I just want to give you guys an idea of what you can expect from these types of accounts and why I chose to invest the way I do. Personally, I like to use eTrade. I know it's not the best platform out there, but I've been using it for many years now, and it suited my case as well. So in my case, I have 5 accounts. I have an eTrade auto invested account, I have a Roth IRA account, I have an Acorns account, I have a SoFi account, which is an auto-invested account, a Fidelity 401k, and then I have my fund money, which I call just a random joint portfolio that I can go and, trade stocks. Another thing I want to say right off the bat is I'm by no means a financial expert, and if you choose to do any of the actions you see in this video, you do so at your own risk. Just to give you guys some context on behind all these investments that you'll see, this is the S&P 500 track. You can see year on year, we're up about almost 22%. So keep that in mind when I show you any investments. The first account I want to look at today is the joint account. Now I have 14 stocks in here and we'd be here forever if I went through all 14 in my methodology behind buying them. So I'm just going to focus on the big hitters and the big losers. The first stock that I actually just recently sold was Nvidia. In 2015, right when I was getting started in investing, I wanted to buy my first gaming computer and I realized there was only 2 graphics card manufacturers you get to choose from, Nvidia and AMD. After scraping together all the money that I could, I realized the only card that really made sense was buying one from Nvidia. I watched tons of YouTubers, I watched tons of reviews. All these signs pointed to Nvidia that they were the best company to buy a graphics card from in 2015. I then decided, well, if they're the best company and their stock price is only trading at $21, I might as well buy a few shares because they own a pretty heavy market share and they're very undervalued in my opinion. However, I asked my parents if this was okay for me to do. They were like, yeah, you just have to know that this money is not FDIC insured and it could go down. I knew that and I wanted to take the risk. I started investing at around the February date and then I sold it somewhere around here. So you can see that's $160 around the 724% range return on investment that I made from that one investment. That's still by far the best investment I've ever had. Now let's move on to my current investments. And again, I'm gonna be showing you all the ones I did really well on, and then I'll show the ones that I did really bad on. The next one that I did really good on so far is ICLN, and this is a global clean energy fund. What it is an ETF that encompasses emerging and existing energy and renewable energy stocks. So you can see I came in around the October frame, and then I'm still holding it now. So you can see in just a couple months, I'm up over almost 30%. I've got in right at the right time. I have been thinking about selling just because with coronavirus and a lot of things going on, but all those things are very short term. And I always tend to do the buy and hold strategy. So if I buy something, I'm at least holding it for at least 5 years. Moving on to my second stock, and this is Coke. Coca-Cola is a blue chip company. They've been around forever, and they're a very good company that I think you can invest in. They're not going to be as volatile as some of these big tech companies. Another reason why I like them is because they have a 2.75% dividend yield without taking any management fees from that. If you're going to be investing in Coke, this is my strategy to basically buy and hold. I'm going to be holding this stock forever. My goal with this one is to just have compound interest on my side, invest in this, dividends reinvested, and just keep building that up over time. The next one is really interesting. So this is AUI. AUI is a gold company. So my thinking behind this one was I invested in this right when Trump got elected. The thinking was that it was a new president, people weren't going to know how to react to him, and the market was just going to go in turmoil. This was in 2016. And if you see in 2016, yeah, that didn't happen. I bought AUI right around here. It was around the 270 frame time, around the 270. And it pays a really small dividend. So I'm still up over time. Traditionally with gold companies and silver, when the market tends to do well, gold and silver companies tend to do poorly just because gold and silver are always seen as a good alternative to traditional investments. The next one has been my 3rd highest performing stock ever, and that is Starbucks. Starbucks was a little risky investment. So my thinking behind this was I'm a college student, and what is the one coffee shop at my college campus where there are tons of places? Starbucks. I think there's about 6 or 7 Starbucks within a mile radius from where I am, and kids love Starbucks. I haven't been to Starbucks in a year, and the only reason I'll ever go to Starbucks is if I have a gift card. If you ever see me at Starbucks buying a coffee, please take me to the hospital because something is really wrong. I refuse to pay that much. I brew my own coffee at home, 20 cents. Don't need much more than that. So I bought Starbucks right around the August 2017 range, and now it's around it's around 87.55 right now. It's been a really great investment. I wish I bought more. They kind of hovered. They hit a peak of about, you can see their 52-week range. They hit almost $100, and I was really considering about selling at the time, but then I just remembered that my strategy is to buy and hold. So whenever I buy these stocks, my goal is to hold them for at least a year. That way I can avoid paying my tax income and I can pay capital gains instead. However, I probably should have sold it at the time, just because if I would have sold it, obviously it's gone down, but I could have sold it and then put that money towards another investment that could have given me more return. So now let's talk about the bad investments, and I've had quite a few. One of the worst investments that I had was Cron. Cron is literally the definition of a risky investment, to say the least. As you can see, does not pay a dividend, doesn't even actually make money. I mean, you can see that that's not a great PE. Overall, I mean, this is just it doesn't even have any analysis research. What it is it's a pharmaceutical marijuana company, and I think I invested in this. Yeah, this has been Cron's track summary, and I think I invested in this around it was around the $16 range, I believe. So I'm down. I only owned not very many shares, so it's not like that was a huge investment, but these are the things that I think it's important to learn, that this is why you want to avoid some of these stocks like this. Sure, you can have these big hitters like Tesla, where you're coming to the gate, and they may not be profitable at the beginning. However, you always just have to take everything with a grain of salt, because these are extremely risky investments. I normally don't even preach buying individual stocks just because they're so risky. And honestly, we're in such a bull market right now that anything you buy basically has gone up. So the last failure, per se, you can want to talk about is Spotify. My thinking behind buying Spotify is you're either going to be using Apple Music or Spotify. I bought Spotify around the June range of 2018. So you can see I have lost money on it. I do own quite a bit of Spotify, so that has hurt, but my other investments have made up for it. Again, this is just one of the things that you can see why this is so risky to buy an individual stock. You can see they're actually negative earnings, so that means that they've actually lost money. They haven't made any money as a company. They've spent more than they've taken in, so they're still taking on investments. I'm still holding them because I see the vision they're trying to do. Eventually, I think these companies, especially like Uber and Lyft, are trying to capture as much market share as possible. Then when they can control the market, then they can start raising and dictating prices. We haven't seen that yet with Apple Music and Spotify. However, I think we will down the road. The same with Uber and Lyft. So overall, if you take my entire fun account into existence, you smash it down, you crunch the numbers, I'm about 10% return. And that's actually not that great. When you consider that I could have taken all this money and just put it into an S&P 500 index fund, and I would have been at about 21%, you can see that I'm not exactly winning. I wouldn't say I'm losing either, somewhere in between. So now moving on to my Roth IRA, I really only have a couple stocks in there. I only have 2 ETFs, but I'm only going to focus on one, and that is the SPY 500 index. So this is like the most generic ETF ever. All this is it's an ETF that tracks the performance of the S&P 500. And you can see down here at the quarter end results that I think I put this in about 10 years ago, that this has been a pretty good stock. I mean, I've had this around here, and I continue to contribute money to my Roth, so it's continuing to grow, and it'd be too confusing to figure out how much money overall I've made from it without showing how much actual value I have. I do have an etrade automatic investing account. I'm really just curious to see if I just give etrade some money, how they'll invest that. You can set different profiles and different characteristics on when you want your money back and things like that. So I'm curious to see how they're doing that. Right now, it's only about a 1% return. But I think I've learned a ton doing this, and investing on your own and knowing that it's your money on the line really makes you do some more research before you just go ahead and spend something. So next, I want to talk about Acorns. And I do have an Acorns account. I thought this was a really cool idea, and I got like a $25 referral from somebody, so I decided might as well throw some money in there to see what happens. And Acorns actually, surprisingly, did extremely well. So I put money in around the August timeframe, and from August to a couple days ago, I just pulled it out. 8% return in just a couple months. So yes, you can look at this and say, yes, this is good. However, again, when you go back and consider the S&P 500 in those 6 months, it's gone up over 15%. The opportunity cost there isn't very great. However, I did not have all of my investments in Acorns and stocks. I think about 30% of it was in bonds as well. So there you can kind of see this little bit difference. Acorns does charge you a $1 management fee, which is new. They used to be free for students. However, they, well, for whatever reason, decided to stop doing that. So as soon as I found this out, I was like, all right, I'm gonna jump ship because there's a bunch of different auto investors that don't charge you anything. So next I wanna look at 401k. And this is again something that I've talked about on this channel for quite some bit. If your company offers 401k matching, please take advantage of this. This can be such a great tool for when you're young to be able to compound your interest over time. Obviously, I'm gonna be blurring out all the company information and anything like that, but you can see here that from 1 year ago, I've had about a 15% return. I'm only investing in one stock. It's the 2060 retirement goal fund or something like that. It's through Fidelity. They manage it. It's basically just a really risky investments because you basically have 40 years to make your money back from this. When you come down here and you look at the investment breakdown, I think this really just solidifies the point I'm trying to say. Is you can see I've contributed 66% to my account and company match has contributed to over 30%. That's huge. That's free money that they're putting in on their behalf to contribute to your retirement account. Like I said, I do have a couple other investments. I have a SoFi account. That's at about 7 or 8% on the year. And then I have a Coinbase account that I don't even lie. By the time I tell you how much I made on Coinbase, it's gonna have changed 10 times from now. So overall, guys, would I recommend getting into investing? Absolutely. It's a really give and take game. I mean, that's seriously what it is it's a game. You have to know what you're doing, or at least you have some idea of what you're doing. If you don't, go ETFs all the way. I think those are a really safe investment. Right now, no one really knows what the economy is gonna do. I mean, obviously, if I knew some stocks were gonna go down, I wouldn't buy them. If I knew they were gonna go up, I would have bought them. It's not a guessing game, but it's an educated guessing game. So that's all I have for you guys today. Thank you guys so much for watching. If you enjoyed this video, please hit the like button as it shows the YouTube algorithm this is a good video. And if you like content like this, hit the subscribe button. With that being said, guys, that's all I have, and take care.